The US just had its debt downgraded, but what does that mean for investors? What does it mean for the stock market? And what does it mean for the economy? Does this mean that we could even go into recession by the end of this year? Let's go ahead and break it down. Now, first, anytime that you hear about the US debt, that is primarily US bonds. That is really what this conversation is about. Why is that the case? Because when you buy a bond, you're giving the government money and they're promising to pay you back at the end of that term. Anytime there's an IOU, that is debt. So that's what we're talking about here. Now, we were downgraded. This means that we went from a AAA bond status, the safest bond out there, the best grade that you can possibly get, and we went down. So think of this of going from an A plus to an A. It is still high, but it's not as high as what it used to be. This is not the first time that this has happened in the US. The first time was back in 2011 for the exact same reasons that we are here today, in that Congress got into a fight. They didn't really pass a debt ceiling deal up until the last minute and had everybody in crisis and panic mode, and then they finally passed something. The credit agency in this case was Fitch. There are three total. There's Fitch, S&P, and Moody's. They come together and create these bond grades independently. This is the exact same system, or rather a very similar system for me and you with our credit scores. It's TransUnion, Equifax, and Experian. Their credit agencies for us, and in this case, businesses as well as governments have credit ratings for them. Now, what does this mean for the US? Well, anytime your debt is downgraded, you are going to pay a different interest rate. So for us as investors, we might start to see US bonds go higher in terms of interest rate and get paid a bit more, which kind of sounds great unless you are a US citizen, meaning that now our payments, our taxes that are going to pay off these loans and pay off this debt, now you're paying a higher interest rate, and it's going to make it much more difficult to pay off that debt in the future. And it also means that the money that could have been going to roads, schools, bridges, military, all that kind of stuff is now going back to pay off the debt. That is a concern for the long term. As an investor, yes, the stock market did fall over the last 2 days, but it really doesn't mean that we need to switch up our investments or really change our investing strategy. So there's no major concern there. It is a concern from a high level macroeconomic perspective on what Congress is going to do and how they're going to adjust their spending. The reason why we're downgraded outside of the consternation and fights that Congress was going through is the fact that we have a mismatch in terms of what we bring in tax revenue and what we're spending. We are spending about 20% more than what we're taking in tax revenue. How do you solve that? It's really three ways. You can cut spending on stuff, which is going to hurt somebody, right? Or you can increase tax revenue by raising taxes or just collecting taxes that you have not collected, which can hurt somebody depending on how much money you hide from the government. Or you can do a combination of both until those things are even and pay off the debt and everything be fine. Now that sounds all great, but you know, Congress is Congress, so that happens. But that is something, that is a solution to that. Now, whether or not that solution is going to happen, according to Fitch and Moody's and S&P, they're not that confident on it. Now, there were some economists and some analysts that feel very differently about what this can mean. From my perspective, as a former advisor and someone who has an econ degree and looks at this stuff all the time, from a long-term perspective, this is probably not going to mean much from an investor's side of things. We're going to keep investing. You know, the first time that this happened back in 2011, the stock market is up significantly since then. I don't really see this, pushing us into a recession or stopping the stock market from growing at the pace that it has at least this year. You're going to need something quite significant to really throw off the stock market. And really, if you go back to 1981, the stock market really doesn't get thrown off or into a bear market or starts to fall off unless there is something significant that happens. And when you go back and think about it, again, go back to 1981 all the way until right now, what were the things that happened to tank the stock market? It was a dot-com bubble that was significant. Okay, things were wild back then in the 99 and the 2000s. Then you had the Great Recession, that was pretty significant. And then you had the coronavirus. And that was it. If you take out those major events, the stock market only fell one time in 2018. That was it. That was it. That was the only time the stock market fell outside of these major catastrophe events, and they don't happen that often. Now, this is not me telling you that the stock market is not going to fall in 24 or 25 or whenever. I'm not putting out that prediction. What I am saying is this is bad news, but it's not something that's really going to hurt our pockets right now. And there's nothing we can actually do right now because there's no election, none of us are running. We just have to kind of sit here and hope that they fix it, or write a letter to your congressman and have them to fix it because it's kind of their job. But aside from that, there's nothing that we can do right now. This is not a panic button. This is not something I think you should play either. I've seen a lot of articles and other influencers saying, hey, they downgraded the debt. You need to go buy this, this, and this, and then you're going to make money because of X, Y, and Z. It's not really a situation like that. The stock market will likely get back to its winning ways, which it has been over the last several months, here pretty soon. In fact, the day I'm recording this, and today is August 3rd, the stock market was up significantly today, primarily because of earnings. This is going to blow over. We're going to talk way more about earnings over the next 2 to 3 weeks because it is such a big earnings season. In fact, at the time that I'm doing this again, I got a notification about Amazon and their revenue being up 11%, which is significant for Amazon because it had been down. So not a recession indicator at this point in time. Not something I enjoy. Obviously, you want the highest grade possible so you can pay the lowest interest rate possible, but there's nothing that's in the hands that we can do as investors. However, there is something that you should know about debt ceilings, US debt, and all that kind of stuff. And I've actually covered all of that right here, where you can learn more about the debt ceiling, why we don't need it at all, and how this entire thing works.